Hello friends, I'm Vijay Bhambwani. I've been trading these markets since 1986. You've given me a lot of love, encouragement and kind words, whether it is on my television shows since the year 2000, whether it is reading my two best-selling books, whether it is my print and electronic media columns, or attending my mentoring courses, which I used to do till the year 2019 at the BSC, NSE, and the MCX exchanges. Now that I'm on YouTube and communicating directly with you, providing you free inputs on our free Telegram and free YouTube channels, could I count on your help to enable me to reach out to a larger audience by sharing our free work with your social media groups, your friends and family, so as to enable me to reach out to a more discerning audience like yourselves and spread the cult of knowledge based trading? I would really appreciate your help in this matter. Thank you. Hello friends. Last week in my video, I told you that banking and financial stocks need to pick up because 33.33% weightage implied that this was a swing sector that would take the Nifty with itself. And look at what's happened. On your screen right now in the inset box, what you're seeing is that the bank Nifty is basically playing catch up with the Nifty 50, and it has basically outperformed the Nifty over a 4-week time frame. Now, as long as the banking and financial stocks are doing fine, I think the broader market should also be doing fine. The second aspect was whether you can really make money without the hacienda hedge or the tail risk hedge. The answer I had told you last week was no, and that still continues. Look at the kind of volatility that you're seeing in the market. Although the retail guys may even be going long, but they may not be making as much money as the amount of risk that they are taking. Now, this is something that is denoted. Risk reward metrics are denoted by Jensen's measure, Traynor ratio, information ratio, etc. Now, this is something that I talk about on my social media posts very often. It's a separate topic for a video altogether, and I promise you I'll record it at some other day. But you might be going long, but the returns may not be commensurate with the risk that you're taking because, as I wrote in my live mint column some weeks ago, it's an institutional market in March. Now, what is the outlook for the week ahead? I'm going to discuss that in our video now. On your screen right now is the weekly market roundup, which tells you that it was the bank Nifty that led the way forward yet again, with the broader based Nifty-50 bringing up the rear. A weak US dollar index, the Dixie, saw commodity prices, especially bullion, go up smartly. Gold rose a little under 4% and silver rose a little under 3%. Now, I've been telling you writing about it in my live mint column that bullion will get buying support at lower levels since many weeks. And here it is. It's the time under the sun for a bullion buff. Crude oil and natural gas fell, which I have been talking about on our free Telegram channel. Please do subscribe to this free channel, and contact coordinates are available at the fag end of this video and in the pinned comment below this video itself. So not really surprising, energy fell. The Indian national rupee rose against the dollar, as you can see from the USD INR. Indian 10-year benchmark bond yields fell 3 basis points, and that had a salutary effect on our GILT fund investments. NSE gained a little bit in market capitalization, and that tells you that the rally was somewhat broad-based. Market-wide position limits, MWPL, went up a little over 6%. Now, the US market indices fell in unison, although in percentage terms, I would say the technology-heavy NASDAQ led the way down. And the tech sector is what I would watch in the Indian markets in the coming week. Friends, I now come to in-house exclusive indicators. I start with the market-wide position limits, or MWPL. It is the percentage exposure utilized by traders as compared to the percentage allowed by SEBI. First of all, every 4 weeks you will notice a dip, that is expiry. And after the expiry of February 2024 contracts, the dip was a lot more smaller as compared to the January post expiry dip. The rally after the expiry week at 35.49% is higher than the second week, commensurate week last month. It compares favorably with the post expiry second week in December. So, risk appetite in the swing traders. Now, swing traders are guys who are basically buy and hold traders. These are called two marshmallow traders. The marshmallow theory is explained in a separate video. The hyperlink to that is in the description and in the pinned comment below. So, two marshmallow traders or institutional strong traders were showing higher risk appetite. Now for the stock and index futures turnover, remember these are three concurrent series. So it is March, April and May. Every 4 weeks you will see the turnover jump. That is expiry because traders are closing their positions in the expiring month and reinitiating them in the next month. So that records a double turnover. Expectedly so, after the expiry week, turnover falls. And here again, you're seeing the turnover fall. But the fall has been very, very sharp. That tells you that retail intraday traders were showing signs of caution. Now, friends, I come to the weekly advanced decline ratio. This is the average of all trading sessions every week. And what you're seeing is that the advanced decline ratio continued to remain below 1 for the second consecutive week. At 0.71 for every 100 losing stocks, there were only 71 gaining stocks. So the tilt was towards smaller risk appetite or smaller buying. Now this is the retail segment. Remember, the MWPL was two marshmallow traders and advanced decline ratio is one marshmallow traders. Now, one marshmallow traders are clearly on the ropes. They are feeling the heat and they are nervous at this point in time. And unless this advanced decline ratio goes above 1 again and stays above 1, I would say that the retail segment is fairly nervous. Friends, I now come to the prompt futures basis. Now, basis is nothing but the premium or discount prevalent over spot. And what you are seeing is the basis collapse in both the Nifty-50 and the Bank Nifty. In the Bank Nifty, it is a lot more pronounced. It's fallen more than 50%. And in the Nifty itself, the fall has been less than 50%. But it has been fairly sharp. Now, that tells you that traders are not open to the idea of paying huge premium on futures as compared to spot. Now that is another small indicator that the retail segment is showing lesser buying conviction. Friends, I now come to our in-house exclusive indicator, the impetus, which you've trusted for more than 3 years now. And what you're seeing is both the indices have logged higher impetus. Remember, both the indices have logged gains last week, and higher impetus tells you that the buying was on forceful and higher momentum. That is a positive sign. Now, if the market was to rise on lower momentum, which it did last week in my video, I pointed out to you, traders are a little nervous. So compared to the previous week, I think the weekly picture shown by this graph is somewhat better. But follow-up buying will determine where the market's headed. Friends, I now come to our second in-house indicator, the lift, weight, thrust, drag index, which you won't get anywhere on the internet. And what you are seeing is, in spite of the fact that the Nifty gain has been smaller last week, the LWTD has bounced from the negative zone to the positive zone at 0.29. That tells you that on declines, there is a likelihood of buying or short covering support coming in to cushion the price. Now, as long as the price is getting cushioned, declines will be small. But ideally speaking, I would want the price and the LWTD to go up together. That would tell me that buying is very, very healthy. Right now, cushioning the decline is also critical. Friends, our in-house indicators done. I now come to the bond market, which is very close to my heart. and we've been taking the lead in covering this market before equities. What you are seeing is the Indian 10-year benchmark bond yield at 7.03%, which is at closed at a multi-month low. That would have a salutary effect on the GILT fund portfolio that you are holding, which I recommended on 14th of December 2023. The insert box on your screen tells you that it is possible to get 10% plus return in a year with 100% government guaranteed investments. Normally, people tend to tell me that, hey Vijay, bonds are boring. Who wants to get into it? Why would I block my funds for poor returns in single digits? But here you have it, 100% sovereign guarantee, 10% plus, and you're seeing over 3.25% yield in 11 weeks since the time we've invested in these gilts. What do I expect in the future? I expect gilt funds to do even better. Our first tranche of gilt fund investments is done. I'm now waiting for the opportune moment to get into the second tranche. I will update this data on our free Telegram channel, so do connect with me there, please. Friends, the bond market done, I now come to the Bank Nifty, and the daily chart on your screen tells you the Bank Nifty gained 1.16% and it rose on 3 out of 4 trading sessions. The price is above its month-long moving average, which itself is trading upwards. Last week I told you that this index needs to break out above the 47,500 level, which it has. And as long as it stays above this level, I would remain optimistic about bulls maintaining their initiative. The short-term outlook for now is positive. We basically move to the weekly chart where we see that the price is above its 25-week exponential moving average, which is a 6-month-long holding on cost of an average bull, and the average itself is sloping upwards. So the medium-term outlook remains positive for now. Now, we've seen throw unders twice in the Nifty bullish wedge formation. Throw unders are when the wedge bottom is violated. That raises the probability of a throw over, which means the wedge top also being violated upwards. If that happens, you're looking at the probability of the Bank Nifty going to 49,000 or higher in the coming week or coming weeks. So the outlook on the Bank Nifty seems positive. And do remember, banking and finance have a weightage of 33% in the Nifty itself. So it's good for the broader market as well. Friends, in the week before last, this index was number 5 on our most volatile counters list based on statistical beta rankings that I maintain in-house. It jumped 3 notches to number 2. That's not good news. Higher volatility is always challenging to a retail trader who can't handle these kind of wild price moves. So it's time to be careful with hacienda hedges in place. Last week, I advocated an estimated range between 48,725 on the upside and 45,850 on the downside, which held perfectly well. In the coming week, I estimate a range between 49,250 on the upside and 46,425 on the downside. In addition to the charts, do check out free daily, weekly, monthly pivots that I update on our free Telegram channel. That will help you trade across all time frames. Friends, the Bank Nifty done. I now come to the Nifty-50, and as you can see on the daily chart on your screen, it's gained 0.69% and like the Bank Nifty rose on 3 out of 4 trading sessions last week. The price is above its month-long moving average, which itself is sloping upwards. The 261.8% Fibonacci extension placed at the 22,200 level has been overcome, and the Nifty is closing comfortably above that level. As long as it sustains itself above this level, bulls are still in the driver's seat. So the short-term outlook at this point in time is optimistic for now. Turning to the weekly chart, what you are seeing is that the price is above its 25-week exponential moving average, which is a proxy for a 6-month long holding on cost of an average bull. So the medium-term outlook is also positive, but the price is far above its 25-week moving average. That tells you that there is room for some consolidation, up and down movement. Now, look at what's happened in the last 4 weeks. All the four candles in the last 4 weeks have been bullish hammers. Now, a hammer occurs when the price opens up. During the week, bears try to push it down, they fail, and the price manages to close higher again. That shows there's a tug of war between the bulls and bears, and the bulls have won because the hammer is bullish. But follow up buying becomes extremely important. Unless follow up buying comes in, I think there could be chances of some profit taking. Although the medium term outlook is okay and is optimistic, in the short term there could be profit taking. So please watch out. Friends, in the week before last, this index was number 17 on the most volatile counters list as per statistical beta rankings that we maintain in-house. It jumped 7 notches to number 10. Again, not very good news because higher volatility is always a challenge for a retail trader. Last week, I advocated a range between 22,850 on the upside and 21,825 on the downside, which held perfectly well in spite of all this volatility. In the coming week, I estimate a range between 23,000 on the upside and 22,000 on the downside. Friends, in addition to everything else, do watch our free daily, weekly, and monthly pivots on our free Telegram channel. Friends, I now come to the last bit of statistical analysis wherein I track the retail risk appetite based on the turnover contribution of the four segments in the derivative space. Now here in the index futures, you saw a 0.09% decline in turnover contribution. It is indicated as a blue line. Stock futures turnover was lower by 0.40%. It is indicated as a red line. Now futures demand more money. They are more volatile than options and they are higher risk. The fact that turnover fell in the higher risk instruments tells you that retail risk appetite was smaller. Now, index options, the least volatile, the lowest amount of capital contribution required in terms of options premium or span margins for option writers, the turnover shot up by 1.06%. It is indicated as an army green line. Stock options, which are relatively more volatile and ask a little more money, saw their contribution fall by 0.56%. It is indicated as a purple line. Net, I would say that retail traders' appetite was lower last week. So it's institutional activity that was dominating the market and it is likely to continue. Do remember, you have advance tax payments coming up in middle of March and individuals are basically trying to balance their books of accounts and closing entries, etc. It's only the cash-rich institutional player who has deep pockets enough to make fresh investments in March ending, which is not surprising why retail traders are basically not making as much money as the risk that they're taking at all-time highs. So friends, I now come to my trading strategy where I have been talking about PSUs, public sector units, and public sector banks, PSBs in particular, which have been hogging all the limelight. That's likely to continue. I will try to seek opportunities in both directions in these stocks. Last week, to be honest with you, I tried trading the public sector units, especially oil marketing companies, on very, very thin exposure. Now, I tried going short. I went short. Prices fell extremely sharply. The fact that moves were in excess of 2 standard deviations tells you that high volatility is something that you need to be guarding against. And look at the lot sizes in future. For example, Indian Oil Corporation is 9,750 shares and it moves by 5 rupees, 3 to 5 rupees every day. Can you really afford to go wrong here? Which is why I tell you tail risk hedge or hacienda hedge is a must. So be very careful out there. This kind of high volatility can cut both ways. I saw spreads were very wide. Now that's another concern with me. The bid and the offer spread is the limit of the buyer and the seller. When it's too wide, my take home profit is lower. I don't like that. I would like to trade lightly when bid and offer spreads are wide. Now, my gilt fund portfolio is doing extremely well. It's at lifetime highs. I'm seeing over 3.25% return in 11 weeks. I can't really be asking for too much more, but I do feel there's still more juice left in the government guaranteed instruments, and the good times are likely to roll and somewhat longer. I think base metals, which saw short covering base rally last week, might just go up a little more this week. Therefore, metal stocks might rise a little more. I continue to seek theta decay opportunities in oil and gas segment, which I have been doing for months and months. And I told you I don't subscribe to the super cycle or the bull market theory in oil and gas. Now, for theta decay traders in oil options, your expiry is on 15th of March. So you need to then start focusing on April option series from here onwards. Overall, I think the kind of volatility that I'm seeing on my screens and on the bid and offer spreads and incremental costs, therefore the spread quadrant, I would trade light. And if there are any more fresh ideas coming into my head, I would gladly share them with you on our free Telegram channel. Please do make it a point to connect. Before I wind up from this video, I request for you to subscribe to my YouTube channel. If you haven't already done so, click on the bell icon to receive instant alerts about fresh videos being put up out here. And in the comments segment, do tell me how my work is helping you become a better trader. Also, help me reach out to smart traders like yourselves by sharing my video across your social media platforms and groups, families, and friends, so I can spread the current of knowledge-based trading. Thank you for your patience and staying with me in this video till we meet again in my next. This is Vijay Bhambwani signing off for now. Have a very, very profitable weekend. Take care. Bye-bye.